So today we're going to dig into federal and state unemployment tax. So if you're not awake yet, be prepared to be excited. So today, here's kind of the roadmap of where we're headed. So we're going to dive into what are taxable wages, taxable wage bases, employer rates, special exemptions, because nothing can be simple in payroll, payment and reporting, and then multi-state workers. So kind of starting from the top here, what is unemployment insurance tax? So this tax is a program that is jointly administered by federal and state governments, and it's funded by payroll taxes collected from employers. So when we're talking about unemployment insurance tax, I think a lot of times people are really only focusing on state unemployment tax, but it's actually a joint program, and we'll dig into that a little bit more when we talk about federal unemployment tax and credit reductions. Employers are required to pay both federal and state unemployment tax if they meet certain criteria, which is usually paying $1,500 or more in wages to employees in any quarter, or having at least one employee for any part of the day in 20 different weeks in a calendar year. Now, with that being said, regulations can vary from state to state. And recently, when I've been doing some state unemployment tax registrations, I have seen that $1,500 threshold much lower in certain states. So states can vary. At the federal level, $1,500 makes you liable. And so what are taxable wages? So when we're talking about taxable wages, it sounds straightforward. It's what you pay people, right? But it's not everything that you pay people. So taxable wages for unemployment tax are the wages that are subject to unemployment tax contributions by employers. So the wages are going to include most types of compensation that you pay to employees, but there are, of course, exclusions. So of course, we're going to include regular pay, salaries, hourly wages, commissions, bonuses. No surprise there that those are going to be considered taxable wages. Benefits and perks. So if they get tips, vacation pay, which could be, PTO, sick pay, any type of pay for non-work hours, and severance pay would also be included in taxable wages. Non-cash payments, so the value of goods or services provided to employees, will also be accumulated in that taxable wage bucket. And then deferred compensation would also be included. When it comes to exclusions, there are many, many exclusions. And just keep in mind that these rules can vary from state to state. So employee expense reimbursements, talking about business expenses. So an employee incurs a cost for something business related and they are reimbursed under an accountable plan, that is not going to be included in taxable wages. If they purchase tools or supplies, uniforms, and are reimbursed for those items, those also will be excluded. Fringe benefits. So a lot of times if an employer has a health insurance plan, they do contribute a portion of either the employee or employee and dependent premiums. And those amounts that the employer contributes would not be included in taxable wages. Likewise, life insurance. So employer contributions to group term life insurance for employees up to $50,000 are non-taxable. After the $50,000, there is an imputed income calculation, and that imputed income would be taxable. And then if an employer has an HRA or an HSA plan and the employer makes contributions to those plans for their employees, those amounts that the employer contributes would also be under the non-taxable umbrella. If an employee gets discounts on goods or services, that is not taxable. And our friend here, de minimis, we always like to talk about de minimis. If they get small things like snacks, we're not going to tax the snacks. Educational assistance, not taxable. And if they get job-related training, you know, something related to their performance, that would also be excluded. We're almost done with the excluded, guys. Don't worry. Certain cash payments. So if you have like a short-term or long-term disability plan, and the premiums were paid by the employee, then they're not taxable. The payments to the disability payments are not taxable. And if they have a workers' compensation claim and are being paid through workers' comp, then the workers' comp money that they're receiving is not taxable income. And then if you give gifts or awards of nominal value, those can be excluded, and dependent care assistance can also be excluded. Full time. We're 11 minutes in. Do I still have people here?
I'm sorry, my poll thing disappeared. I'm still looking for it. I don't know where it went. Here it is. Sorry about that.
As long as I know it's not my fault, that's okay.
Okay, you should. Oh,
All right. So
okay.
true or false? Employer contributions
Yeah, I'm so sorry.
to health insurance plans for employees are considered taxable wages. True or false?
Let's see. I think that's everyone. I'm going to end the poll now. Let's see if it brings it up to share. Okay, here are the results.
All right. So far I've got everyone's attention. We have everyone said false, which is correct. All right. So a couple other things to kind of keep in mind here. Section 125 contributions. So those are going to be when an employer sets up a Section 125 plan and then has the benefits, medical, dental, vision, usually. The amounts, the deferred salary amounts for those benefits are excluded from taxable wages for federal unemployment tax purposes. And so those amounts would not be included in the $7,000 wage base. But when it comes to state unemployment tax, that can vary from one state to another. So we were talking earlier about payroll systems. And if you don't know the laws, you can't really validate if your payroll system is doing things or calculating things accurately. And this is one thing that I've actually seen is you set up a Section 125 deduction, but it's not actually following the state's rules for whether or not that should be included in taxable income. So definitely make sure you know your state's rules on the treatment of Section 125 contributions, so that even if you're using a payroll software, you can make sure that the system is calculating that correctly. And then for retirement contributions, when it comes to federal unemployment tax, both employee and employer contributions are excluded from the taxable wage base, so not subject. And then just like with Section 125, when it comes to the state unemployment tax, the exclusion of retirement contributions from the taxable wage base generally aligns with federal rules, but it can vary from state to state. So make sure that you do know the laws of the state or states that you have employees in. So when we're talking about the taxable wage base, this is the amount of wages for unemployment taxes that the employer is going to pay that tax on. So basically there's a cap on the amount of wages that will be taxed, or, a maximum tax amount per year per employee. And that applies to both federal and state unemployment taxes. With federal unemployment tax, of course, that wage base is going to be universal, but at the state level, the wage bases vary pretty dramatically between the states. And then the states can update that taxable wage base from one year to the next. It doesn't mean they do every year, but they can. So when 1/1 comes around, that's always a good time to double check. And again, make sure your system is set up properly, because that can change from year to year. So in 2024, for federal unemployment tax, the taxable wage base is set at $7,000 per employee per calendar year. So again, putting those two concepts together, the first $7,000 of taxable wages, so not including the items that are excluded, that is what will be taxed for federal unemployment tax. It's kind of interesting to see the history of the federal unemployment tax base. So when it started in 1939, it was at $3,000 per employee per year. So we haven't come that far. It went up in 1972 to $4,200. 1978, it increased to $6,000. And then in 1983, which was over 40 years ago, it increased to $7,000 and has remained there ever since. So I would not be surprised if we see something change in the near future. If you're looking at the history, it increased a couple of times, and then it has just kind of paused, which is interesting that the federal government has not adjusted that. And then, as we talked about with the state unemployment taxable wage base, every state sets its own. So if we're looking at the examples here, California, surprisingly, is at the lower end. $7,000 is the lowest of any state. There's no state that has a taxable wage base less than $7,000. Oklahoma, where we're is at $27,000 per year. Texas, $9,000. And then Washington coming in at the high end at $68,500. So when we're, talking about what this looks like for employers, depending on where you have employees, state unemployment tax may be fairly insignificant or potentially very significant, depending on how much of the amount you pay employees is actually going to be subject to those taxes. I'm going way too fast. All right.
Sorry, I forgot I was on mute.
That's okay. All right. So what is the federal unemployment taxable wage base?
We've got 9 answers so far. And then Stephanie, okay. I think that's everybody. I'm going to end and we will share.
All right. And so it looks like everyone answered correctly. Again, federal unemployment taxable wage base is at $7,000.
Very good. Okay.
Okay. So for state unemployment, each state determines the employer's unemployment insurance tax rate, and those rates can change annually. So a lot of times they're going to be assigned based on the employer's unemployment claim history. And although the rates are assigned annually, most states that's going to be a January 1st effective date. But New Jersey, our friends in New Jersey, update these on July 1st every year. So one of the things that we see a lot as a payroll service provider is that employers forget to get their new rate updated when the year rolls over. And so usually in quarter 1 is when you will see a lot of issues with the UI rate. So if the rate went up, of course, you're going to have underpayments. If you're using electronic filing, you may not know that you've underpaid until you get that notice. But sometimes when you go to e-file, you'll get an immediate rejection if the UI rate doesn't match the state's website. We usually see that in Oklahoma when we try to e-file. We'll get a rejection if the rates do not match. But if you are not paying attention, if you're not getting that rate updated, of course, it's math. So if you don't have the right calculator in there, you're not going to have the right tax amount, and it will end up being under or overpaid. If you're a new employer, many states will have a set rate for all new employers or a rate for non-construction new employers and construction new employers. But the rate can vary by state and industry. So if you are going into a new state, a lot of times you can go onto the state's website and find what that new employer rate is, or it will specifically tell you that rates are industry rated, and you would have to apply in order to get your UI rate. Keep in mind in the payroll system, sometimes you will be blocked from processing payroll if you don't have rates or tax IDs in the system. So you want to make sure you're registering as soon as possible. And again, the liability for unemployment tax will vary from one state to another. But as long as you're completing the registration, then you will know if you're liable or not. A lot of times, if you're not liable yet, your registration stays open and you can circle back and just proceed with the initial registration once you become liable. And then, as we mentioned, rates can be affected by claims. And so states will use a look back period or experience period to determine the state unemployment tax rate. This is usually 3 to 4 years. So what that means is if an employee makes a claim for unemployment benefits and it's granted, then that will affect your UI rate for up to 3 to 4 years. Depending on how much you're paying in UI tax and how much the employee gets as a benefit, it's a math calculation, paid in versus paid out. So larger employers will be less impacted by a few claims. But if you're a smaller employer, even one claim can significantly impact the UI rate. And again, that's going to stay with you. It's not just for 1 year, it will be for several years. So again, during the look back period, the state will look at the payroll and the amount of unemployment benefits paid to former employees. And then they use that data to calculate the employer's experience rating, which impacts the UI rate. Another way that rates can be affected is if employers don't file or pay their state unemployment taxes. Depending on the state and how many returns you failed to file or pay, they may penalize you with a higher rate. And that penalty rate is usually astronomical. Obviously, the intent is to get you to get those in and get them filed. Another thing that states will do that often confuses employers is they will do estimated wages if you don't file. And so sometimes clients will get a notice and they'll send it to us and ask, why is it showing $20,000 in payroll or whatever the case is? And again, it is a.
Well, I was surprised. I didn't have to ask him.
It
But
is.
it's the customer side of firewall. It's the business systems for that.
Jennifer, do you mind muting?
All this stuff.
Thank you. So make sure that those are getting filed, make sure that they are getting paid. Otherwise, your rate will go up. You can also have penalties and interest. And at the end of the day, again, the UI rate significantly impacts the total amount of tax that the employer will pay. So you really want to make sure you're protecting that rate. Another way to protect the rate is to respond to benefit claims notices. A lot of times employers will just disregard them. And then what usually happens is the employee's word is just taken because there's nothing to say otherwise. And again, more claims equals higher rate. So make sure you're responding to the claim notices with the information about the termination. Make sure you're filing your taxes, make sure you're filing them on time, and make sure you're paying them. At the end of the day, that's going to have a huge impact on the overall cost of your state unemployment taxes. And then for federal unemployment, this seems unnecessarily complicated. So the actual federal unemployment tax rate is 6%, but there is an available credit. So if an employer doesn't have any outstanding loans with the federal government, they can get a credit of up to 5.4% against the FUTA tax rate. And so that would effectively reduce the FUTA tax rate to 0.6%. So when businesses get the maximum credit, then the rate is 0.6% on the first $7,000 that they pay to each employee, which makes the maximum tax $42 per employee per year. So federal unemployment tax, usually fairly insignificant, but we do have credit reductions, of course. So states with an outstanding federal advance for 2 consecutive January 1st are subject to a potential credit reduction. Then if they go another year, they're subject to an additional 0.3% reduction of their FUTA credit. States with an outstanding federal advance after the 3rd consecutive January 1st are subject to a 2.7% add-on. And then states are potentially subject to the benefit cost rate add-on for passing at least 5 consecutive January 1st with an outstanding federal advance. And so they actually have it posted now on their website, the potential 2024 FUTA credit reductions. But the tricky thing about this is that they don't confirm it until after November 10th. And so what happens in the payroll system is the whole year you're calculating FUTA tax at 0.6%. And then at the very end of the year, we find out the states that have a FUTA credit reduction, and you have extra tax to pay if you end up being or having employees in one of the states with a credit reduction. This is really hard to explain to employers why they have an extra tax. Did you do something wrong? I've been paying this all year. So again, with FUTA tax, the actual tax rate is 6%. There's a credit on it of up to 5.4%. And then if you're in a state that has outstanding loans for too long, they will reduce the credit. So right now for this year, potentially, we're looking at California, Connecticut, and New York for FUTA credit reductions. Last year, I think there were only 0.6 in California and Illinois, if I recall correctly. But so it can, more than double the FUTA tax. And again, good luck explaining that to your boss if that happens where you have employees. Seems to be the same states that end up in this situation, though. So there are a few different kind of types of employees or employers that have special exemptions when it comes to state unemployment tax. For agricultural employers, they're usually exempt if they paid less than $20,000 in wages in a calendar quarter, or if they employed fewer than 10 workers on any day in each of 20 different weeks. But again, as with most things that we're talking about with state rules, those rules can vary from one state to another. So when you are doing your registration, just make sure you're paying attention to that state's rules if you are working with an agricultural business. Same thing goes for nonprofits. So 501c3s may be considered exempt, but that will usually depend on the number of employees they have and the amount of wages paid. Now, nonprofits that are liable for state unemployment tax often have the option to elect to be a reimbursable employer. And so, what that means with state unemployment tax, normally you pay the tax at the UI rate up to the taxable wage base, you pay that quarterly. And then, if an employee has a claim, you do not pay the employee directly. That money comes from the state. And again, that's why it impacts the UI rate. But a reimbursable employer is one that does not pay that tax quarterly. They will still file the returns, but they will have a 0% rate. But then if an employee makes a claim that is granted for unemployment benefits, now the employer has to pay that out of pocket because they haven't contributed to state unemployment tax quarterly like a regular employer. And then for domestic workers, so that's going to be, nannies and housekeepers. States have specific wage thresholds to determine if employers are liable. So again, the threshold there will depend on the state where you have the workers. And so same classifications of employers, but now talking about federal unemployment tax. So for agricultural employers, they are liable for federal unemployment tax if they paid $20,000 or more in cash wages for agricultural work in a quarter in the current or previous year, or if they had 10 or more employees working on at least one day in each of 20 different weeks within the current or prior year. For nonprofits, 501c3s are exempt from paying FUTA tax. And then for your domestic workers, they are subject to federal unemployment tax if they pay wages of $1,000 or more to any domestic worker in any calendar quarter of the current or previous year. So again, federal unemployment tax is going to be general rules. We're just talking about one tax agency. But when we talk about state unemployment tax, the rules are going to vary from state to state. There are similarities or, most often cases, but definitely check with each state when you are trying to figure out if you're liable for those state unemployment tax accounts. All right. So now we've calculated all this tax. How do we get it over to the tax agency? For state unemployment tax, generally do quarterly. If you're working with a very, very large business where they have a super high liability, depending on the state, you may have to pay state unemployment tax more frequently, but a majority of businesses are going to find that their payments are due quarterly. And with those quarterly payments, they're going to be due by the end of the month following the end of the compliance period. So January 31st for quarter 4, April 30th for quarter 1, July 31st for quarter 3, and for quarter 2, I'm sorry, and October 31st for quarter 3. When it comes to paying the state unemployment tax, you can do that through EFT, online tax portals, check or money order. Of course, if you're using a payroll system, you're remitting through the payroll system, but on the back end, they are still doing one of these things, either through EFT or online portal usually, although we were just discussing that some large payroll companies still send checks, which was surprising to find out. And then, of course, if you have late payments or filings, you may see or will see penalties and interest charges. Those can add up pretty quickly and are very difficult to have abated. The states just don't seem to want to mess with it most of the time unless you have a very, very valid reason for things being late.
Christina,
Yes.
yeah, there's a couple questions in the
Oh, I'm
chat.
sorry.
Do you want to take the time to answer that now or wait until you're finished with the presentation?
Let's see. So, okay, so I've hired an employee in Texas, but currently our state registration is only in Florida. Can I apply for a payroll tax ID in Texas without registering with the Secretary of State? Until I receive the tax ID, can I pay the employee directly? So whenever you are hiring an employee in a new state, usually liability occurs once you process payroll. So you usually would do a payroll first, but when you process that payroll, you still want to have the employee assigned to Texas if that is where they are working. With Texas specifically, the new employer rate is 2.7%. So you can plug that into your payroll system and have the liability calculated prior to receiving your tax ID. And again, just talking about Texas specifically, you can do that registration online, and usually the tax ID is provided as soon as the registration is submitted. To my knowledge, you don't have to register with the Secretary of State. We work with a lot of businesses that have remote employees, and so they usually are not registering with the state prior to us registering for the state tax IDs. So you can do that through the TWC website. And again, usually that tax ID is generated immediately. And as far as paying the employee directly, if that means outside of the payroll system, my answer is always no. Or I would say my advice is always no. Don't, at the end of the day, if you pay someone outside of your payroll system, you're going to have to record that later, which means you're going to have to either take the taxes that you should have taken from a future check or gross up the pay. It just really overcomplicates things, and it's really not necessary, especially when talking about Texas, because you could go on, in the next 20 minutes while we're on this webinar and get your tax ID. And then
Unless
Yep.
you are a nonprofit. In
True.
Texas, you have two options. If you're a nonprofit, you either don't have a liability at all if you have fewer than 4 employees. But if you have fewer than 4, you have to determine you can opt in to their unemployment or the reimbursement kind. So I had to do this recently. That's why I know.
Yep. In the case of 501c3 organizations, do we need to apply for tax ID, and will the state determine that we are exempt, or will we not even need to apply? So normally when you are applying, you still would register. And normally if you are a 501c3, they're going to request a copy of that letter from the IRS stating that you're a 501c3. And then, the registration itself will prompt you to answer questions about how many employees you have, how much you pay them. And then if you are deemed non-liable, it should tell you that at the end of the registration. There are certain states too where you can't do the normal registration process as a 501c3. You have to do a paper form rather than online. I'm not sure if that's what you're talking about, Candace. And then in Florida, do we need to send the RT6 and 940 anyway, informing the exemption? So with state unemployment tax, again, if you know you're not liable, I mean, I guess you don't have to apply, but the registration process itself will determine liability. And then for nonprofits that are not, if you're 501c3 not subject to federal unemployment tax, you do not need to file a 940. And I think that was it. Yes.
Yes.
Yes, that was all those questions.
Okay.
Thank you.
Sorry, I was not looking at those.
No, that's all right.
So when it comes time to do your state unemployment reporting, you will have to have each employee's name and social security number. Sometimes it'll just ask for a first initial, but you need to have that information readily available. of course, employees' taxable wages. If you had an employee that worked in one state and then moved to a different state, you will want to report that as wages paid to the other state, because a lot of times you can get credit for wages that were already taxed. And then one new thing that we're seeing is some states are now requiring SOC codes on the state unemployment returns. If you're using a paper form, you're also going to have to do your own calculations for excess wages. You'll have to show the premium calculation and also input your employer information if you don't have a pre-printed form. But if you are filing online, that portal will already have the UI rate plugged in. It will calculate the excess wages for you and calculate the premium. Oh, we've got another question. The real question would be whether I need to wait for the state secretariat's registration deadline 1 month before going to TWC to apply for the payroll tax ID. Not sure I follow that one.
He's talking about Texas, the TWC. I think, would you need to wait for the secretariat's registration deadline of 1 month before? I will tell you, Adriano, in my experience, I actually, I work for a nonprofit and have Texas employees, and we opt in for every state that we're allowed to. In fact, I've only found one state that we weren't allowed to opt into. And in Texas, I actually sent an email to the TWC. It's out there on their website, and they were really helpful. They just sent me all the answers I needed back in an email. They sent me the forms I needed and told me exactly what I needed to do. So I recommend reaching out to them, get the email address from the website, and contact them directly.
All right. So for your SUTA reporting, just like those payments for state unemployment tax, the reporting is due quarterly. And then electronic filing, most states, I can't think of any off the top of my head that don't have an online portal, but online portal is the way to go if you are doing this on your own and not through a payroll system. And then some states will actually require electronic filing or payments. So again, just make sure that you're paying attention to states' rules and following them when it comes to your reporting. And then for federal unemployment tax, these are due quarterly, but only if the accumulated liability exceeds $500. So if the FUTA liability is $500 or less in a quarter, the employer can carry it forward to the next quarter, and they can continue to do that. If they never reach $500 over the course of a year, then that will be due by January 31st for the prior year. The IRS doesn't want you to send them checks. They want you to do everything electronically. So you can do that through EFTPS if you're doing payroll on your own. You can do ACH credits through a financial institution or through your payroll processor, or do same-day tax wire payments through your financial institution. I think most people are probably using EFTPS or a payroll system, but overall, you just don't want to send the IRS a check. And then the IRS does not mess around with their penalties. So if you have a failure to deposit penalty, if you're just 1 day late, 1 to 5 days late, you're going to pay 2% of the unpaid deposit, 5% if you go up to 15 calendar days, 10% if you exceed 15 calendar days. And then if you get a notice and don't pay them within 10 days from that, it's going to go up to 15% of the unpaid deposit. It's not where we're going today, but there's failure to deposit, failure to file. We're talking about the 940, but of course there's also the 941. So the biggest mess that a business owner can get into when it comes to your payroll taxes is not filing or not paying the IRS, the 940 and the 941. So on the 940, which is the form that you use to report federal unemployment tax, the form is due annually by January 31st. And then if you have employees in more than one state, or if you pay employees in one of those credit reduction states, you will also need to include Schedule A. And on the form, you're of course going to need the business information, the states that you paid employees, and then it'll break it down into total payments made to all employees, payments that are exempt from FUTA tax, excess wages, adjustments, which is going to be wages excluded from state unemployment tax. If you pay state unemployment tax late, they're going to charge you. And then, of course, the FUTA credit reductions. And then on the second page of the 940, you're also going to have to break out your liability by quarter. So in a payroll system, I mean, this is all usually calculated for you and populated on the form, if not filed electronically. But if you are still doing payroll manually, you have some math to do when it comes to federal unemployment tax. And then now I think really since COVID, we've seen a huge increase in multi-state workers, remote workers, people moving all over. And so when it comes to state unemployment insurance tax, it's usually based on where the work is performed. So one thing that often gets asked is, if my business is in Texas, but my employee works remotely from Oklahoma, what state do I use for state unemployment tax? That's a pretty easy answer. It's going to be Oklahoma because that's where the employee is living and working. If the employee transfers temporarily to a different state, then the employer can still continue reporting and paying wages to the state where the employee normally works. And then, of course, if the employee permanently transfers or moves to a new state, the employer has to start reporting to that new state. And again, going back to what we were talking about with the SUTA reporting, you should report those wages that you paid to the other state, and you could potentially get credit for it. Louisiana and Minnesota are the only states that don't allow the employer to carry forward wages paid in another state in the same year. So you definitely don't want to get double taxed if you don't have to. So if you have employees moving around, just make sure that you're not only setting up those new states and changing where you're reporting the tax, but also taking credit for anything that you've already paid. And then if you have an employee that works in more than one state during a compliance period, there's a 4-step process to use to determine which state to report the wages to. And so these go, in order that they appear here. So you would never just jump, for example, to the employee's residence. So first you're going to use where the work is localized. So if they usually work in one state and then sometimes or occasionally work in another state, you're going to use that primary state for SUTA reporting. If that is not something that applies, then you can jump to base of operations. And that's when the employee isn't working only in one state, but they work in a state that the main office is located in. That is the base of operations. You use that state for state unemployment tax reporting. If that still doesn't apply, then you go to place of control. And that's when they don't work in just one state, but they also don't work in the state where their main office is located. Then you can check if they perform any work in the state where they receive direction and control. And then lastly, employees' residence. So if none of these other things apply, then you can use the employee's residence state when doing state unemployment tax. But again, don't make the mistake of just using the employee's residence state if they work in more than one state, if one of the other 3 things apply. It does go in order, and you don't want to jump down the page. You got to start at the top. We see this, I worked at a pipeline staffing company, and they wanted to use employees' residence for everything without going through this ladder here. And you definitely don't want to do that. All right, our last poll. First 2 came pretty quickly, so let's see who's still hanging in here. True or false? Generally, state unemployment tax is based on where the work is performed.
Okay, let's see, we've got 9 answers so far, and there's 10. Okay, I'm gonna end it. Share.
Oh, guys, I thought we were all together here. Just kidding. So we did pretty good. 80% said true, 20% said false. The answer is true. Generally, state unemployment tax is based on where the work is performed. The issue that comes into play is if the employee works in more than one state, then what do you do? So hopefully I didn't confuse that issue. All right. And so just to kind of wrap up here, key takeaways, when we're talking about state unemployment tax, the taxable wage base is determined by the state each year, so that can change annually. Each employer is assigned a UI rate annually, I should say each liable employer. Filings and payments are typically due quarterly on the last day of the month following the quarter end. And then the tax is normally based on where the work is performed. For federal unemployment tax, the wage base is $7,000 for all liable employers. The tax rate, tricky, 6%, but with a potential 5.4% credit. So 0.6% if you're not in a FUTA credit reduction state. And then payments are due quarterly when the liability or accumulated liability exceeds $500. And that is the end here. So I appreciate everyone that joined us today. Did put my contact information on the screen here. So if anyone ever has any payroll questions or just wants to talk about payroll, you can find a good audience here. As I know, if you talk to non-payroll people about payroll, their eyes just kind of glaze over and they try to look away. So if you ever need a payroll friend, my contact information is here.